Hello traders, Cory Mitchell here with TradeThatSwing.com, and this is your swing trading stock market outlook for the week of March 17th. Are you having fun out there yet? It's been, pretty much a straight sell-off the last few days, but conditions are looking interesting. We actually have some changes this week where we've gone from poor to mixed, where we did have one that was holding up well last week, but now we have another one that's coming in, potentially giving us a bullish signal. So we'll discuss that. We'll look at Bitcoin. We'll look at gold and gold stocks. There is a couple watch lists here. There wasn't much. This one was updated early March, and there wasn't a ton on it. But we have had a couple. We had I believe one, maybe two gold stocks on there. So the Chinese stocks have been doing okay. So those were two areas that were doing okay. And so this will get updated probably on Monday, maybe even this weekend if I happen to get to it. But that's just high momentum names over the last couple months. We have the best performing stocks and ETFs. These ones were also recently updated. The buy the dip stock list, buy and hold stock list, best long-term dividend stocks. You may think, what the hell are you talking about, Cory? This is a swing trading thing. Well, the market health indicators are useful for picking up investments as well. So if there's one of the names on that list that maybe I've been eyeballing and I want to get into, it's a growing company, it's been solid, but it's had a recent sell-off. As market conditions start to improve, that's the time when I'll maybe pick up one of those. And it's not a swing trade. I might be looking to hold it for several years, but it's still, I can use this swing trading analysis to help decide when I'm going to buy those longer term trades as well. So let's look at the price action. NASDAQ broke below its prior swing low, so it's in a downtrend. S&P dropped below its prior low. It had been chopping around up here. It dropped below. Downtrend. NYSE holding up. Big up move, big down move, big up move, big down move. Holding that range so far. The Canadian index, same thing. The Russell 2000, we've talked about, it's been in a downtrend for quite a while. So it's way below that swing low as well. So downtrend. So that's not ideal from a price action perspective, of course. The one kind of saving grace is that this is the broadest measure of stocks. The NYSE composite includes stocks from all different industries, all different sizes, and it's kind of holding. It's not quite in a downtrend yet. It's not really in an uptrend either, but at least it's kind of holding in that range. And these other ones, which are a little bit more specific on certain sectors or size of companies, are in a bit rougher shape. So not ideal from a price action perspective. What does that tell us? If things aren't ideal, hey, limit your exposure or have no exposure. But as we'll talk about with the market health indicators, there are a couple things that are looking all right. So we'll discuss that. So if price action is bad and market health indicators are bad, we're not really getting along at all. If we have a little bit of goodness, maybe we consider a little bit of exposure. If everything's looking good, that's when we get, we're pushing our chips in, so to speak. Bitcoin had these little ranges going on, and we've talked about the sort of boxes and range rules in recent videos. I can't remember if I actually called them range rules, but that's what I call them in my day trading. And it's basically once, if we break out of a range, how does it act once it moves outside that range? And that determines how I'll trade. So in this case, we had the breakout, rejected. You can see we popped back into that old range, but we didn't get any sort of move up into it and then a bounce back off the bottom of the box and then a move up. Instead, we break down, bounces off the box, and heads lower. So basically, if you think of kind of trends, we want to have boxes stacking up. In a downtrend, you would have boxes stacking down. And basically we have boxes stacking lower from this point to this point. And now, we don't quite have a range here yet, but you can see like a lot of whipsawing going on here. You could draw another box around there. So you basically have boxes moving down at the moment until you start to see boxes moving up. And you can have little boxes within bigger boxes to start to see, as price is starting to move, maybe it's starting to build boxes up within a bigger box, and then it starts to build its way up. And that's how trends reverse, how they continue. Gold, anyway, so Bitcoin, I'm going to go long. I'm waiting for an opportunity to go long in it, so it's dead to me at the moment. I need to see that building to the upside. Nothing bullish going on yet. The gold miners running nicely to the upside along with gold. We've discussed this. And I break it up into two kind of things. While the general market conditions are not good, you can have specific sectors that are doing well. So when I say limit long exposure, I'm talking about the kind of general market, and if you're trading typical stocks. But if a specific sector is doing extremely well, then you could be pushing in your chips into that specific sector, because there was a time when the market wasn't doing well, but the semiconductors were just flying up. Sometimes energy will be flying up while the market's not doing really good. So you have these oil and gas stocks, which are just doing really well. Right now we have gold stocks. The market's been tanking, but you have gold stocks moving up. And there was one recently on the best swing trading stocks list that triggered along to the upside. And there's been a bunch. If you were running scans looking for stocks that are strong, you would have come across a lot of gold stocks that have been forming patterns breaking higher, forming patterns breaking higher. So there's that specific sector that's doing well, and we could trade in that sector if you want. But basically outside of those little microcosms, conditions are not good. But they're starting to improve. Let's look at the health indicators. So this is the S&P 500 chart. We can see it broke below that prior range. Volume not important to me yet. It will become important soon. Once we're a few days into this rally, we just had a low point. That would have been Thursday. We had a nice pop on Friday. So once we get a few days into that rally, we'll get to see if we get a follow-through day. That's a strong upside move several days into an attempted rally. And it's like rallies in bear markets tend to fail fairly quickly. So if you get a few up days followed by a very strong up day several days into that attempted rally, that's a good sign. So we won't get that for several days. We won't know if that's coming. This is rate of change, which is simply the percentage daily movement. And it's a one-day rate of change, so it's just how much did the S&P move that day. We had a big 2% drops are a big red flag. So we had one. We had a whole bunch. So this has been kind of neutral to bearish for quite a while. We had these big drops. They didn't quite hit the 2%, but they were definitely warning signs. It's like things are volatile. Uptrends are characterized by lower movement, like what we see in this area here. And if you look at uptrends, like you just have extended periods where it's just like this, like very small daily movement. That's more characteristic of an uptrend. Downtrends more characteristic of percentage movements like this, where it's a little more chaotic, big price moves. So this was indicative of more downtrending type behavior, even though we were kind of holding up near the highs at that point. Still a warning sign. We got a big drop. I believe that was March 10th, like 2.7%, if I recall. So a really big single-day drop. Big warning to get out, to avoid going long for at least a little bit. We had another one on Thursday, but didn't quite hit that 2% threshold, down day. And we had a big up day. Now, I do have to do a little bit more research on this, on the up days. Like, I've mostly used this just for looking at down days. Like, if it's 2% down, that's my signal. I want to avoid going long for at least a couple days. Wait till things settle, then reassess. But the 2% up days, I did a quick, I went through like several years, and after a decline, a 2% up day, this was just over 2%, yeah, 2.13%, did look fairly bullish. There were a couple, out of like, let's say 15, 3 or 4 weren't good, but 10 or 11 were good. And so, nothing's 100% in trading. So, yeah, I would say overall, a pretty good bullish indicator, but I would definitely want to go through more charts to kind of start including that in my analysis. It's not something I've really looked at, mainly because I have another thing which I look at. We'll get to that in just a second. But yeah, that could be a bullish signal. So I'll do a bit more research on that. But temporarily speaking, or at least based on a quick analysis of several years, this looked to be a good short-term bullish indicator. The big pop. NYSE advanced decline line, advancing stocks minus declining stocks as a cumulative number. It will often move with the indices. We can see a big divergence, positive divergence, on the advanced decline line. So these lows here on the S&P equated to these lows here on the NYSE advanced decline line. And you can see we're holding up way above it. Like basically, the advanced decline line is holding up pretty close to its highs, while the S&P and even the NYSE index fell quite a bit, right? So that I like. Good, good thing there. Up volume divided by total volume. We have not had a signal in here in a long time. We got a 90% upside day on Friday. What does that mean? Out of all the volume that occurred that day, 90% of the volume occurred in stocks that moved to the upside. That is a rare event. When it happens after a decline, the data shows that it is typically a bottom often forms in a very high percentage of the time, within about 10%, the 90% upside day occurs within 10 days of a bottom. And often it can mark very close to the bottom, but you may get a 90% upside day, a little bit of drift lower, and then continuation. But basically, kind of like what this one's showing, a big 2% move to the upside, is that money moved very aggressively into the market. So that is a bullish indicator. So we have, this one kind of neutral to smiley face. This one, but it's also very volatile. So that's why I left it as neutral. It's like, okay, we're still seeing a lot of volatility. That's indicative of downtrending behavior, but at the same time, we have this, at least what seems, based on my preliminary thing, a bullish. This is looking good. Now this one's looking good, but we have this one looking ugly. This is the percentage of stocks above their 50-day moving average. So the red line is S&P 500 stocks. The green line is all U.S. stocks. The symbols are MMFI for the turquoise one on TradingView, and S5FI, because my head's in the way there. You can see them there. Yeah, and you can see they're pretty abysmal. The percentage of stocks below their 50-day moving average is, around 30% of stocks are above their 50-day moving average, meaning 70% of stocks are below in short-term downtrends. Nothing magical about the 50-day, but it is a crude measure of stocks in uptrends. It is generally going to be easier to make money when most stocks are moving up and trending up and above their average prices. In terms of looking for, some people say, well, if these get really low, is that a buy point? No, sometimes they bottom out at 20, sometimes they bottom out at 0, sometimes they bottom out at 10. Other times they barely get below and then bounce off. So I do not use this as if it gets really low, that means it's oversold and we should buy it. No, it's an indicator that says take trades when it's easy money. And the easiest money tends to be when most stocks are moving up. Most stocks are above their 50-day moving average. So this one's still not good, but we do have a few that are looking good, and that's why I say some exposure may be good. Yeah, so that was the thing. Sectors, as you could expect, nothing looking really good over the last week, month, 3 months. Yeah, all combined, not looking very good. As we talked about, though, there are little microcosms within some of these sectors that are moving good, mainly gold. And we haven't talked much about the Chinese stocks, but if you've run a scan for stocks that are doing well, you probably would have come across those as well. So yeah, as discussed, general market conditions poor, but if you find a microcosm where the conditions are good, then we can potentially trade in that sector. So what I'm doing right now, enjoying the volatility, I will consider some long exposure in individual stocks. That is separate. That's talking about, outside of things that have been performing well, such as gold and the Chinese stocks. I can start to look outside of those ones as they start to recover. Gold still in play, gold stocks still in play. Bitcoin's dead to me right now. And as always, day trading. And what I do like about the day trading, as I mentioned in each of these videos, you can find things every day. There's opportunities every day, whereas swing trading is more a action followed by periods of inaction followed by periods of action. So depending on what kind of personality you are, one of those styles may favor you a bit more. So that's your weekly outlook, and happy trading out there.